The most popular way to organize a business is as a limited liability company, otherwise known as an LLC. LLCs require less paperwork than C corporations and S corporations, while giving owners some of the same protections against being held personally liable for any actions of the business. But the true advantage of this title comes in the form of tax benefits. LLCs give business owners significantly greater federal income tax flexibility than a sole proprietorship, partnership, and other popular forms of business organization. An important feature of an LLC is that the Internal Revenue Service, IRS, allows business owners to choose the way their business will be taxed. They can choose to be taxed as a sole proprietor, a partnership, an S corporation, or a C corporation. You choose how you'll be taxed by filing IRS Form 8832. However, there are some limitations on the aforementioned choices. An LLC with multiple owners can't choose to be taxed as a sole proprietor, for instance. The IRS will automatically tax an LLC as a partnership if it has more than one owner. Also, LLCs and sole proprietorships have the same default tax structure. However, LLCs are also eligible to elect S Corp tax status, which could potentially result in them paying fewer taxes than a sole proprietorship, depending on the situation. You can learn more about rules for taxing LLC from the IRS Backgrounder on Form 3402, covering taxation of LLC. Here are some of the best benefits of choosing an LLC. 1. Personal liability protection. The main advantage of LLC is that they provide members with personal liability protection. This means that an owner's personal financial assets aren't in danger if the LLC goes into debt or is sued. Sole proprietorships and general partnerships do not offer this protection. However, keep in mind that owners can lose this protection if they do something to pierce the LLC corporate veil. This includes things like mixing personal finance accounts with business accounts and committing fraud. A related advantage of LLC is the charging order. If one of the members has personal debts or owes a judgment from a lawsuit, their creditors may go after personal assets, which would include an ownership stake in any business. A charging order puts a lien on that member's earnings from the LLC, but it protects the earnings and ownership stakes of the other members and also allows the indebted member to continue their role in the company, without giving the creditor any power to run the business. 2. Tax options. LLCs are subject to pass-through taxation by default, which means the LLC profits and losses pass through to each member's individual tax return and are taxed at the owner's personal tax rate. As a pass-through entity, the LLC doesn't have to pay any federal corporate income tax. This means that the owners can avoid double taxation, which is not the case for owners of corporations. By default, a single-member LLC is taxed as a disregarded entity, and a multi-member LLC is taxed as a partnership. This means that LLC automatically benefit from pass-through taxation, where the LLC profits pass through to each owner's individual tax return. The LLC is not taxed as a business entity, meaning that the owners can avoid double taxation. LLC also have the option to be taxed as either a C corporation or an S corporation, which may be beneficial depending on a few factors. The benefits to corporate taxation include: A. Single-member LLC may find that a corporate tax structure strengthens their line between personal and business finances. B. The corporate tax rate may also prove to be more beneficial to some LLC. 3. Easy to form. Compared to C Corp and S Corp, LLC are very easy to start. You should be able to form an LLC on your own without the help of an attorney. LLCs are generally inexpensive to form and maintain. The main cost of forming a limited liability company, LLC, is the state filing fee, which ranges between $40 and $500, depending on your state. 4. Less paperwork. Corporations are more regulated than LLC and have considerably more paperwork. LLC are not required to have a board of directors, keep meeting minutes, or hold shareholder meetings. This means much less time and money spent on keeping records and filing compliance-related documents. 5. Management and ownership flexibility. LLC can decide between member-managed vs. manager-managed structures. Member-managed means that the members are actively involved in managing the company's operations. In a manager-managed LLC, the members delegate the responsibility of managing the company to a manager who may or may not be a member. In this case, some or all members may act more as passive investors. LLCs also aren't required to have a board of directors, which allows management to be more independent. LLCs have few restrictions on the number of owners they can have as well as how the LLC is managed. An LLC can choose to be member-managed or manager-managed, that is, whether the LLC is managed by its members, owners, or by an appointed manager. In contrast, a corporation must have a board of directors that are elected by shareholders annually. These annual meetings must also be used to conduct company business. An LLC does not have to follow these formal regulations, and the owners have more choice in the management structure of their business. 6. Credibility. Forming an LLC is a step up in credibility from a sole proprietorship or partnership. Customers and other businesses will find an LLC more credible, and starting an LLC can show people that you are taking your business seriously. 7. Simple formation and maintenance. LLCs are overall easier to form than corporations and require less maintenance paperwork. The most common requirement for LLC is that they must file a formation document, such as the Articles of Organization or a Certificate of Formation. Some states do not even require that LLC file periodic reports, such as an annual report or a biennial report. While LLC should have an operating agreement for their business, it is often not required. On the other hand, corporations are often legally required to hold an annual shareholder meeting, record meeting minutes, maintain shareholder records, record important business resolutions, file an annual report, and pay an annual fee. In short, the more laid-back structure of an LLC may be more appealing to small business owners in the face of all of the corporate regulations. However, LLCs also have disadvantages. All LLC investors pay tax on the earnings of the LLC regardless of whether they received a distribution or not. Investors must also wait to file their personal taxes until they receive their K-1 form from the LLC. Because of this hassle, investors are often less likely to fund LLC. For comparison, C Corp investors only have to pay taxes when they receive dividends from the business and are able to follow a more straightforward tax filing process. This simplicity makes C Corp more appealing to investors. While you may be able to deduct the cost of forming an LLC and capital expenditures, such as materials and equipment that are used by the business, there are some limits to what you can do when it comes to deducting other expenses. Specifically, you may not be able to deduct benefits like health and life insurance, which you might be able to do if you organize as a C corporation. If your LLC provides you with these types of benefits, you may have to pay taxes on them as well.